Thank you for joining me today. Today we're going to be discussing Chapter 10 of my book, Financial Independence, Getting to Point X. Specifically, we're going to be talking about preserving your estate. Please take a moment to read this famous quote, and then I'll jump right into the presentation with you. So in this chapter, we're going to answer a few questions that will introduce you to the topic of estate planning. So question number 19, do you or your spouse have a will, and has that been reviewed by an attorney within the last 5 years, and was it drafted in the state you currently live in? If the answer to that is no, then you definitely need to revisit your will. So the question about a will is, first of all, does everyone need a will? The answer is no. It depends on the facts and circumstances. The second question in this chapter deals with, do you have a healthcare proxy and a power of attorney? These are also two important legal documents. Ultimately, in the estate planning process, you want to work with your investment advisor, CPA, financial advisor, to draft up a plan that's going to make sense, that works for you. But ultimately, we have to have a lawyer involved with some estate tax planning experience that's going to be able to actually draft up the legal documents. These are the three legal documents that I think are going to be critical at a bare minimum. The other one would be setting up a trust, which we'll talk about a little later. So what is a healthcare proxy and a living will? Just want to read this slide to you. Healthcare proxy and a living will both have the same purpose: to see that your medical wishes are expressed and honored, even when you can't do it yourself. You give a medical proxy the authority to make those decisions for you. That's the big distinction. While with the living will, you set out what those wishes are in writing, so that decision is not left to your healthcare proxy. So the big question here is, if God forbid you became terminally ill, you're now on life support, the only thing keeping you alive is a machine, you may want to put in writing what your intentions are as far as whether they should pull the plug or not. That's basically the purpose of a living will. So in terms of estate, gift, and generation skip tax, a couple of important things you need to know. Number one, what is the estate tax rate? It's actually 40%. That's kind of frightening. Let's assume you were to pass away and your estate was worth $22 million. Well, the first $12 million, there's no estate tax that applies. The additional $10 million, $4 million of that, 40% of the $10 million, is going to go in federal estate taxes. That is a ridiculously scary number to me. And let's face it, if you followed all the rules in my book and you managed to accumulate extreme amount of wealth, and now you want to leave that money to your loved ones, the government is going to end up taking 40% of that. In essence, they're naming themselves beneficiary of part of your estate. So this is why estate tax planning is so important, because there's a lot of sophisticated and some not so sophisticated strategies you could implement to dramatically lower your estate tax bill. If you're a high net worth individual and you haven't done some meaningful estate tax planning, you really need to make this one of your priorities. So what is the current threshold? Here we go with more updated numbers. For 2022, the basic exclusion is actually now $12.06 million. If you're a married couple, you could double that to $24.12 million for married couples. And again, that number will continue to be adjusted for inflation every year. Another concept here with the federal estate tax exclusion is the concept of portability. And what portability means is that when you die, you have up to $12 million, a little over $12 million in estate tax exclusions. If you leave everything to your spouse, then you could end up losing that exclusion altogether. What portability does, as long as the taxpayer files an estate tax return, and even if you're not required to file an estate tax return for your spouse, you may want to file an estate tax return to report their assets. There'll be no estate tax to pay, but there's a box you need to check off that says that upon your death, the surviving spouse, they could utilize not only the estate tax exclusion that belongs to them, but any estate tax exclusion that the first spouse that died did not use up, that could be transferred over to the surviving spouse. So again, especially if you're a married couple, this rule of portability means a lot, and it's applicable to you. So again, very important from an estate tax planning point of view. Okay, now in addition to that, currently there is an estate and gift tax exemption amount of $16,000. What are we referring to here? Well, right now, let's assume you have a very large estate. You can make a $16,000 gift to as many people as you want. Let's assume you have 4 children and 20 grandchildren. You could gift each of them $16,000 each to help reduce your estate, which will also reduce your estate tax liability. As long as you keep the gifts under $16,000, there's no gift tax filing requirement. Once you give a gift of more than $16,000 to any one individual in any one year, you're required by law to file a gift tax return. You will not pay a gift tax on that, but that will be a permanent record that will eventually affect your estate tax liability after you pass on. So portability is related to the marital deduction. I already discussed that with you. What you want to do, this concept was created in the 2010 Tax Act. And in order to take advantage of it, your spouse, even if they otherwise would not require to file an estate tax return, are going to want to file one to claim the portability rule. This is filed on a Form 706. If you haven't taken advantage of this and your wife or husband died within the last 5 years, they recently passed a tax law that you could still go back and amend and file that. So again, I bolded this and also underlined it. A federal estate tax return can now and should be filed for sole purpose of making the portability election, even if the decedent has died and had little or no assets. As long as that person didn't die 10 years ago, it had to be within the last few years, you have an option to still do this under the tax law. So some of the more advanced estate tax planning strategies include lifetime gifting, where you take advantage of that $16,000 per person per year over a long period of time. Another strategy is valuation discounts. Those would be available to you if you have closely held businesses. It's also available to you if you own a Delaware statutory trust. It's also available to you if you have qualified opportunity zone investments. There's valuation discounts that apply. There's irrevocable life insurance trusts that you could set up. Those are particularly helpful for ultra high net worth individuals because you could basically make gifts into the trust every year as part of the $16,000 gift to your children. That would pay for life insurance. And then ultimately, upon your death, that life insurance gets paid into the trust, and that money does not get included in your estate. So that's an advanced strategy that we implement with our ultra high net worth individuals. There's a long list of strategies here. Can't possibly cover them all, but one of them is the spousal lifetime access trust. Another one is a qualified personal residence trust. That relates to your primary residence and how you could protect that. There's grantor retained annuity trust and qualified terminal interest trusts properties as well. So these are all very sophisticated strategies. I'm only naming them here for the purpose to give you a wake-up call. If you're a high net worth individual, you need to start implementing some of these strategies. Otherwise, the government is going to be one of your primary beneficiaries, whether you want that to be the case or not. So, in summary, the action plan under this chapter is as follows. Decide which legal documents you need to ensure you and your estate are taken care of properly. Keep in mind that if you die without a will, your estate will be distributed according to the relevant laws in the state you live in, so you have no say over who receives your inheritance. It's based on what the laws are in the particular state you live in. Take advantage of gift-giving strategies that can help lower your overall taxable estate. Make sure you understand the difference between the various types of property ownership. Make sure they're all titled correctly and things have appropriate beneficiaries named. If you have a significant estate, you must also meet with an experienced estate attorney and implement some of the more advanced estate tax planning strategies I mentioned earlier. You should determine if you are currently living in a state that also imposes a state-level estate tax and also inheritance tax. There are certain states that also impose, in addition to the federal estate tax, a state tax, and there's also certain states that will tax actual inheritances to the people that receive those inheritances. So I can't possibly cover all 50 states with you today, but if you have questions on this, speak to your CPA or feel free to reach out to me. I'll be happy to answer any general questions you have.